Stock market recovery. Dow, S&P 500, Nasdaq rise amid Fed rate cut hopes. Is the stock market finally ready to shrug off its recent jitters? After a concerning jobs report sent shivers down investors' spines last week, Wall Street is showing signs of resilience today, fueled by renewed optimism about potential Federal Reserve interest rate cuts. But here's where it gets controversial. Some analysts believe this rally is premature, a mere dead cat bounce before further declines. What do you think? As of this afternoon, the major indices are painting a much brighter picture than they did just days ago. The Dow Jones Industrial Average is leading the charge, climbing approximately 424 points, translating to a solid 1% gain. The broader S&P 500 is also enjoying a healthy rebound, up by 1.2%, and the tech-heavy Nasdaq Composite is outperforming them all, surging ahead by 1.7%. This suggests investors are regaining confidence, particularly in growth-oriented companies. So, what's driving this renewed optimism? Many believe it boils down to the aforementioned hopes for the Fed to ease its monetary policy. Last week's weaker-than-expected jobs data, while initially alarming, has inadvertently strengthened the argument for the Fed to consider lowering interest rates sooner rather than later. The logic is simple. A slowing economy might prompt the Fed to step in and provide stimulus by cutting rates, which would, in turn, make borrowing cheaper for businesses and consumers, potentially boosting economic activity and corporate earnings. And this is the part most people miss. Lower rates also tend to make stocks more attractive compared to bonds, as bond yields become less appealing. However, it's crucial to remember that the market is a complex beast, influenced by a multitude of factors. While Fed rate cut hopes are undoubtedly playing a significant role, other elements are also at play. For example, lingering concerns about potential trade wars, particularly those stemming from former President Trump's tariff proposals, could quickly dampen investor enthusiasm. These tariffs, if implemented, could disrupt global supply chains, increase costs for businesses, and ultimately hurt economic growth. Beyond the broader market trends, several individual companies are making headlines today. Keep an eye on stocks like Palantir, Nvidia, Tesla, and Berkshire Hathaway, as they are experiencing notable price movements and could offer valuable insights into the current market sentiment. These companies often act as bellwethers, providing clues about the health of specific sectors and the overall economy. For instance, strong performance from Nvidia could signal continued strength in the technology sector, while Berkshire Hathaway's movements might reflect Warren Buffett's assessment of the broader economic landscape. Chris Larkin, Managing Director, Trading and Investing at E-Trade for Morgan Stanley, aptly summarized the situation, stating that last week we saw the first real cracks in the labor market, and it was arguably the decisive factor in tipping the market in favor of the bears. This highlights the significant impact that economic data releases can have on market sentiment and investor behavior. Ultimately, the stock market's direction remains uncertain. While today's rebound is encouraging, it's essential to approach the market with caution and do your own research before making any investment decisions. Are you buying into this rally, or do you think a correction is still on the horizon? Share your thoughts in the comments below. Stocks surge. Investors bet on U.S. rate cuts. Imagine a world where the global economy is on the brink of a significant shift, and the fate of interest rates hangs in the balance. This is the reality we're facing today, as stocks rise and investors cling to hopes for U.S. rate cuts. But here's where it gets controversial. The recent U.S. jobs report has sparked a dramatic reassessment of the rate outlook, leaving many to wonder if the Federal Reserve will come to the rescue with a September rate cut. As of now, the chances of such a cut are at 85%, and the markets are responding accordingly. The Europe's STOXX 600 rose 0.5% in morning trading, and U.S. stock futures are up, indicating a potential recovery from Friday's sharp decline. But what's behind this sudden change in sentiment? The answer lies in the disappointing U.S. non-farm payrolls report for July, which missed expectations and revised the figures for May and June sharply lower. This sparked a sell-off on Wall Street and dented the dollar, leaving many to question the reliability of U.S. economic data. And this is the part most people miss. The downward revisions in the payrolls report have left the 3-month average of jobs growth at 35,000, down from 231,000 at the start of the year. This significant drop has led some experts to suggest that the labor market may be weakening more than initially thought. As Pepperstone market strategist Michael Brown noted, the net revision is the biggest takeaway from all that. Such a chunky net downward revision suggests that this could well be a more pronounced weakening in labor market conditions that is underway. But that's not all. President Donald Trump's decision to fire the head of labor statistics has added an extra layer of nervousness over the credibility of U.S. economic data. And with the news that Trump will get to fill a governorship position at the Fed, worries about the politicization of interest rate policy are growing. As Ray Attrell, head of FX research at NAB, said, it opens the prospect of broader support on the Fed board for lower rates sooner rather than later. The markets have essentially already eased for the Fed, with 2-year Treasury yields down almost 25 basis points on Friday, in the biggest one-day drop since August last year. So, what does this mean for the dollar? The currency is flat after Friday's sharp reversal, but it's still up against a basket of 6 other major currencies. The euro is down 0.1% at $1.1578. While the pound is up ahead of a widely expected quarter-point rate cut on Thursday from the Bank of England. The Swiss franc, on the other hand, took a beating after Trump announced a 39% tariff on Swiss imports. In commodity markets, gold is little changed, but oil prices are extending their slide after OPEC Plus agreed to another large rise in output for September. The increase completely reverses last year's cuts of 2.2 million barrels per day, leaving Brent crude futures down 1.7% at $68.48 a barrel. As we move forward, it's essential to consider the implications of these developments on the global economy. Will the Federal Reserve deliver a rate cut in September, and what will be the consequences of such a move? How will the politicization of interest rate policy affect the markets, and what does this mean for investors? These are the questions that need to be answered, and we invite you to share your thoughts in the comments below. Do you think the Fed will come to the rescue with a rate cut, or will the economy continue to weaken? Let us know your opinion, and let's start a conversation about the future of the global economy. Stock market today. Dow surges 500 points amid new tariff talks. Live financial update. In a dramatic rebound, the stock market surged on Monday, with the Dow Jones Industrial Average soaring by 500 points. This rally spanned across various sectors, from utilities to the more volatile meme stocks, marking a significant recovery from last week's downturn. Last week's market fluctuations were fueled by President Trump's unexpected tariff announcements and a disappointing jobs report, alongside the controversial dismissal of the Bureau of Labor Statistics chief. These events led investors to speculate that the Federal Reserve might lower interest rates come September, a move that could ease borrowing costs and stimulate economic activity. The market's swift recovery caught some investors off guard. Thomas Martin, a senior portfolio manager at Globalt Investments, expressed his surprise, noting that he had anticipated a longer period of lower prices before the rebound. People are hesitant to wait too long, he remarked, highlighting the urgency felt by many in the market to capitalize on potential gains. Adding to the week's surprises, President Trump announced late Sunday his plans to appoint new leaders for both the Federal Reserve and the Bureau of Labor Statistics. This follows the unexpected resignation of Fed Governor Adriana Kugler, a Biden appointee, opening up a strategic opportunity for Trump to influence future monetary policy. As the week progresses, All eyes are on the looming trade deadline this Thursday, setting the stage for potentially intense last-minute negotiations. Switzerland has already signaled its readiness to present a more appealing trade proposal after being hit with a steep 39% tariff. Meanwhile, the European Union has opted for a strategic pause, delaying its planned retaliatory tariffs against the U.S. for 6 months, hoping for a resolution. This week is also crucial for corporate earnings, with major companies like Palantir, McDonald's, Disney, and Uber scheduled to report their financial outcomes. So far, the earnings season has been positive, with over 80% of S&P 500 companies beating earnings expectations. In the markets today, the Nasdaq Composite led with a near 2% increase, while both the S&P 500 and the Dow Jones Industrial Average grew by over 1%. This is a notable turnaround from last week, which marked the Dow's worst performance since April. In other news, shares of American Eagle Outfitters surged over 20% following President Trump's praise of the company's latest advertising campaign. In the financial sector, benchmark Treasury yields dipped slightly to around 4.2%, and the dollar gained strength against the Swiss franc. Meanwhile, oil prices experienced some volatility, following an agreement by 8 OPEC Plus countries to increase output starting September, aligning with market expectations. But here's where it gets controversial. How will these new appointments and potential policy shifts impact the market in the long run? And this is the part most people miss. The intricate dance between market expectations and actual economic policy can lead to unpredictable outcomes. What are your thoughts on these developments? Do you think the market's optimism is warranted? Or are we in for more surprises? Let's discuss in the comments below.